Good morning. Tonight, we turn to a rapidly evolving story at the intersection of global trade, aviation, and industrial policy, one that is raising difficult questions about tariffs, competitiveness, and the future of North American aerospace manufacturing. Over the past several months, a series of developments involving international airlines, aircraft manufacturers, and government trade decisions have revealed growing stress within one of America's most strategic industries. At the center of this shift is a paradox that few anticipated. Policies intended to protect domestic jobs may be contributing to their relocation. Recent reports indicate that authorities in Asia have instructed domestic airlines to pause acceptance of new aircraft deliveries from a major U.S. manufacturer. At the same time, several international carriers have publicly signaled they are exploring alternative suppliers amid rising trade-related costs. Meanwhile, political leaders in North America have doubled down on commitments to prioritize domestically sourced materials in national projects. These events, taken together, reflect a broader realignment in the global aerospace supply chain. Last year marked a turning point for the American aviation giant, long regarded as a symbol of national industrial strength. Leadership changes followed a series of quality control challenges. Labor disputes intensified at key manufacturing plants, and international customers began reassessing long-term procurement strategies. As geopolitical tensions deepened and trade barriers expanded, the global aviation market, particularly in Asia and Europe, began shifting its sourcing decisions. Aircraft components once produced within tightly integrated North American supply chains started moving towards alternative partners. Against this backdrop, a significant development emerged. Just months after new aircraft component tariffs were introduced, the manufacturer announced multi-billion-dollar contracts with several Canadian aerospace firms. The agreements covered a wide range of work, including fuselage assembly, avionics integration, and long-term maintenance programs for both commercial and defense aircraft. What surprised many observers was not only the scale of these contracts, but their structure. Rather than shifting production overseas, the work was assigned to Canadian companies operating facilities inside the United States, particularly in industrial regions such as the Midwest. Analysts say this approach allowed the manufacturer to remain technically compliant with tariff rules, while restructuring its labor and supplier relationships. From a business perspective, the incentives were clear. Contracting with foreign-owned firms offered flexibility in wages, benefits, and regulatory obligations. Engineering and technical labor costs in Canada are generally lower than comparable positions in major U.S. aerospace hubs, and Canadian firms often operate under different employment frameworks. For American labor unions, the reaction was swift and deeply critical. Union leaders described the move as a betrayal of workers who had supported the company through strikes, restructuring, and production slowdowns. In several manufacturing communities where aerospace employment has spanned generations, morale dropped sharply as workers faced renewed uncertainty, not because demand had collapsed, but because the rules of competition had shifted. Behind the immediate controversy lies a longer-term strategic contrast. For nearly a decade, Canada has invested heavily in aerospace capacity. Public funding supported workforce training, advanced manufacturing infrastructure, and applied research partnerships between universities and industry. This steady approach focused less on confrontation and more on reliability, predictability, and long-term planning. By comparison, U.S. trade policy emphasized rapid, high-visibility actions. Tariffs were framed as tools to force production back home, but critics argue they were not paired with sufficient investment in modernization, retraining, or productivity enhancements. Companies faced higher input costs without parallel support to offset them. The difference in outcomes is becoming visible. While American political leaders debate next steps, production lines under new contracts have already begun operating. Workers north of the border are seeing increased hiring, expanded training programs, and rising investment in aerospace-related technologies. Cities that once struggled to retain technical talent are now attracting engineers from abroad. At the same time, industrial communities in the United States are confronting difficult questions about their future. Veteran engineers, machinists, and technicians describe a sense of displacement, not just economic but cultural. Skills refined over decades are no longer a guarantee of local employment. Younger generations are reconsidering whether traditional manufacturing careers still offer stability. Economists say this reflects a broader lesson of the modern global economy. Market size and political influence remain important, but they are increasingly balanced against stability, policy consistency, and execution capability. In an era of fragmented supply chains and geopolitical risk, companies value environments where long-term planning is possible without sudden regulatory shifts. The political response has been sharply divided. Some leaders have criticized corporate decisions and threatened punitive measures, while others argue the situation exposes flaws in trade strategies that prioritize symbolism over competitiveness. Within both major parties, lawmakers from industrial states are questioning whether current policies are achieving their intended goals. For voters, particularly in manufacturing regions, the issue has become personal. Many supported trade protection with the expectation it would secure jobs. Now some are realizing that protection alone does not guarantee prosperity without sustained investment in innovation and workforce development. Across the border, the narrative is different. Canadian officials and industry leaders frame the moment as the milestone, evidence that long-term planning can pay off. Analysts there note that success has come not from loud declarations, but from consistent execution and institutional stability. So what does this moment tell us? It suggests that protecting workers requires more than tariffs. It requires building competitive capacity, modern infrastructure, and adaptable skills. It highlights that in today's interconnected economy, trust and predictability can rival raw economic power, and it underscores that industrial leadership is no longer inherited. It must be continuously earned. As the aerospace sector adjusts to these realities, the outcome remains uncertain. The shift underway is not the end of American aviation, but it may be a warning sign, one pointing to a world where preparation matters more than promises.